Hey, everybody, the Mavericks are back to give you guys a piece of their mind. So, hope everyone's doing well out there. Great to have everyone back with us. Mike, Scott, thank you guys for joining today. How you guys doing?
Good. Good. I thought we were back so that people in the comments could give us a piece of their minds.
That's usually what happens. That's the truth, right? They're like, man, that one call they made was just so horrible. But and they're probably right. We all have bad calls from time to time. That's the nature of being an investor and trader. But where should we start today? Let's start with the Fed. And this is something that I mentioned to you guys just before we went live. What do you guys make of the fact that supposedly we had this really dovish Fed yesterday, and we saw the markets ripping up. Bitcoin was down to 60,000-ish and then ripped back to 67 and change. Yet today, the dollar is reversing all of the downside, and yields are basically back to where they were. And I just want to show my chart here. So look at this candle. This was yesterday on the dollar, and look at today. And if the Fed is dovish, doesn't that imply that the dollar and yield should be going down, not up? Why is that happening?
Swiss National Bank cut rates, Brazil cut rates, the rest of the world's heading towards recession. The U.S. is the shining star. And anytime we have problems here with risk assets and globally, dollar always goes up and gold's leading the way. So to me, that's part of it. Scott, thoughts?
Yeah, I think that's exactly right. I think that, the Swiss franc obviously is kind of viewed as some flight to safety often. And when the dollar starts crushing the franc, there you go. You have to remember that the dollar strength is relative to a basket of other currencies and is not in a vacuum. So I like to call it the prettiest pig in the pen. A lot of people say the cleanest shirt in the dirty laundry. Either way, it just has to be doing better than the other ones. It doesn't mean it has to be doing good.
How about you, Gareth? What do you think? You
saw I'm in the same camp. I think you guys are right. Is that it's the nicest house on the block? Whatever, we could spit out about a million of these different analogies. But I think you're right about that. Is that when you look at the U.S., people still say that's the place to invest. That's the place to be. It's still the reserve currency, even though a lot of us out there believe it's slowly going to degrade over time. It's still the best one out there, and so I think that's right. And so I guess taking it one step further then is, do you guys believe the Fed that we're going to have 3 rate cuts this year, like the Fed kind of reinforced? Oh, no.
I give that a massive no, but I've said that the whole time, and maybe I'll eventually be wrong. That's a Bitcoin chart, but that was my dollar chart here. But no, I don't think they will. I think that people view something as dovish when it's literally just Powell saying the same thing over and over and over again. And I remember I think it was November, when everyone said he pivoted, right? Have you seen any pivot? I haven't seen any pivot, right? Have you seen predictive markets take anything into consideration except for hopium? No, but everyone hopes there's going to be cuts. There's no cuts. There's no reason to cut. If the economy is strong, they're not going to cut. Why would he cut? I just don't get it.
So Mike, but wait, Mike, let me just ask you a question. So yesterday he reinforced the 3 cuts this year, and the market loved it because after 2 months of CPI and PPI going up with inflation upticking, I guess people were wondering, oh man, is he only going to say 2 cuts or 1 cut or no cut? But I know you've talked about deflation. What are your thoughts here? Is this just a kind of a random occurrence of CPI popping? Are we going to see it turn back down, or what are your thoughts there?
Well, I love that word hopium. I needed to show one thing real quick. I actually tried that with my editors. They wouldn't let me use it. Like, darn, that's a great word. I was convinced them to use boomerangs. They learned on that one. But you mentioned CPI, so I can run through a few charts, but I'll just show you one really quick. And this one's been early. It's been wrong. But the fact is, retail sales on a year-over-year basis minus CPI is negative. And we have the highest Fed funds versus this negative CPI repeat retail sales like ever. It's like silly stuff, how bad it could be getting and how far the pendulum is swung. Oh, we're getting a soft landing, no problem. The U.S. stock market's going up, everything's great. And then, I can tilt over a few other charts that make me convinced that this big reset that I was way early on last year is maybe why the Fed is starting to still say we're going to be cutting rates. And can I show you one on that? On gold, first of all, is volatility. First, this is, I'll just show 1 or 2 and then we can tilt over. I mentioned this last week. I want to show again. This is a VIX volatility index minus the T-bill rate. It's a good way to measure volatility. It's just potentially bottoming. It's a 12-week average here, bottoming from the lowest level since 2007. I remember this well. That's back when I was trading and I was way long puts and long gold, and it took me a while, but it finally worked. It just, you never want to be bearish, bullish in the stock market when the volatility is at a almost 20-year low. It's just one of those things that's happening. And I feel very concerned that this is going to have some mean reversion. And I want to show you one chart that, I mean, my tilt's over. And then I showed you this one earlier. This is the S&P 5 E-minis. We have that little gap there. Copper's bounced above. We used to call it the whack-a-mole trade. It's bounced above $4. And I look at it as a trader, what I'd be doing is like, I'll be structuring some put strategy on that, make copper prove itself. And this is copper and the S&P 500 on the same scale. I just take the S&P 500 and divide by 1,000, and you got the same dollar price as copper. I'll stop there. But to me, this is what's going on. Is this is the end of the first quarter, and I look at it as, the S&P 500's total return is 10% this year in the quarter. That's a great year, and do you expect that to continue? So we're going to have a 10% drawdown. It's going to happen this year.
Mike,
that's not a surprise.
We have crypto people watching. Can't say 10%.
Dude, I was thinking the same thing. I'm like,
they need to make 10% in 30 seconds, man. I always joke that like it was a good year for me in the last decade before I found crypto. If I made 10% of my portfolio, I was super excited. And now, if you haven't made it on a meme coin in 30 seconds, you're a loser.
I know. I feel like and Mike, you could probably sympathize with this. Like, I feel like I'm like the old guy who's like, back when it was my day, I used to walk to school uphill both ways. Like guys, this 10% in the S&P is like, that's a good gain for a year, and people are like, dude, no.
Nothing.
Well, I want to show you some stuff. I enjoyed some of the stuff I enjoyed publishing lately. Is first of all, let's talk about bond yields. I showed you earlier. If you want to get, they talk about. I've heard this my whole career. Is China is going to sell their treasuries, and Japan's going to sell their treasuries, and Russia's going to sell the treasuries. I'm like, where are they going to go? Guess what? You can get maybe 100 basis points less in Greece. You got that going. You get 200 basis points less in Germany. You get basically zero in Japan, and 200 basis less in China. So what I want to show here, if you just take the U.S. Treasury 10-year note and you take the average of China, Japan, Germany, and India, those are the top next 4 countries in the world. Their average yield in 10-year notes is 115 basis points below the U.S. Why? Because they're all tilting towards recession. Maybe not so much India, but there's a few problems there. And I just want to show you one thing that's been happening is, to me, this is the gold divided by the SPY. Gold has been going up. It's bounced to level, but it's been outperforming the SPY on a total return basis. That's the S&P 500 since the end of 2021. And what happened in 2022? The paradigm shift. First, we had the unlimited friendship, then Russians' invasions of Ukraine. And who's the best buyer on gold on the planet? China. And then we had the biggest rate hike cycle on the planet. And that's, to me, is what's kicking in. And I'll show you a few charts. We can go back to them. Crude oil's bumping up to the upper end of the range. This is the D's contract. The high last year was 80.11. I look at it as a trader. And if I'm worried about equities and markets getting up, I'm probably testing shorts there. And then why should the stock market have a problem? So I've heard this quote. This is the S&P 500 divided by GDP. You take GDP in trillions, add 2 zeros, and you got the S&P 500 going back to 1927. Basically, average has been 1 to 1, and right now it's the highest since 1937. Okay, that's a bit dicey. So what are the things that matter? I showed you retail sales. They're in a recession. Here's another thing that's in recession. Remember those things that used to matter, leading indicators? This is the longest period ever of leading indicators below 5% without a recession. Maybe it won't work this time. That's also just like the yield curve. Other things that are showing recession that are not going to matter until they do. The people will notice this once the stock market goes down. That's why I'm waiting for that 10% correction. This is something this is diesel demand in this country. Every single time we talk about this, I keep pushing this line back. Diesel demand in this country is the same as 2014. It's never happened. 10 years, it's the same. It's declining. And then container boards, everything you order on Amazon, it's in a recession. And one thing I'll end with this, I find shocking, is it's never happened before, is you have total holdings of gold ETFs down 10%. Now, some of that's going to Bitcoin, and gold price is up 10%. That's on a 1-year basis. So this kind of stuff it's unprecedented. And by the end, it's great trading environment. By the end of the year, I'm fearful this is going to be part of that, what was a recession last year that tilted back to soft landing is going to just tilt back a little bit towards recession.
All right. So just cutting over here now towards Bitcoin. I know a lot of people are here to talk crypto. Scott, I just remember I saw this like 3 or 4 days ago. You were talking about that you were seeing signals of a decline in Bitcoin, and I think people got on your case about it because God forbid you actually talk about a decline. But honestly, you were dead right. You were dead right on it. It dumped out to 60,000.
10% later, a day later. Yeah.
Yeah, just a 10% again. I don't know. But tell me about what's going on. What are your thoughts on now in terms of the Bitcoin? Has Bitcoin corrected enough for you? Do you think there could be downside?
Right now, I think so. I think as much as I love to say it's not correlated, pretty indisputable that it bounced right at FOMC yesterday alongside everything else. So I think that when the confidence comes, it helped a lot on the bottom of that bounce. And maybe there's a little less of that euphoria that I was hinting at the other day. But I will tell you, when I post things like that, which was me basically saying I have some concerns, everything's massively overbought. There's bearish divergences on the chart. Meme coins are going wild. People are sending money, $30 million in 30 minutes to an anonymous person on Twitter who just posts an address that then deletes the tweet, right? I mean, we were seeing this kind of activity, the full gambolero, casino, YOLO. And then I say, I do this for sentiment. I post it because it's my real concern, but I'm posting it as much just to see how people
test
comment.
the waters, right?
To be honest, a lot of people were very reasonable and said, hey, I kind of agree, like a corrections do. But then you get man, this is a new paradigm. We've got ETFs. It can never go down. You're an idiot. You boomer. Memes are the future. This is you don't understand the kids. And I'm like, man. But and then we got the 10% more, right? So maybe that's enough. If we went to 60 or went to 57, 58, it's all sort of the same to me. We just had a lot of GBTC selling again. We had 1.5 billion in the last 3 days, really, Monday, Tuesday, Wednesday, pretty astounding outflows from GBTC. A lot of people pointing to, oh my gosh, there's outflows from the ETFs, but there's not. There's outflows from that ETF and inflows to every other ETF. So those are still performing well.
So just to clarify, even during the sell-off, there were still inflows into the other ones, even on that day?
That's correct. So when we've seen the huge GBTC selling in the past, we had the unlock first, of course. So the beginning we understood, but the big ones have then come later with news a week or two later. FTX was cleared to sell $1 billion in GBTC, and that was one of the major outflows. Or maybe this has to do with Gemini. Either way, people are clearly running for the hills from the product that has 1.5% and maybe some legal concerns attached to it. But IBIT had, on the worst day, 72 million in inflows, right? So this is not people rapidly selling off all of their, you would see it across the board on all 10 of them if it was if people were reacting to the price being down. So as long as we're getting net inflows, things look pretty good. I will say on the chart here, you're looking at it. I mean, this was a slightly scary candle if you're a chartist, on a weekly candle, a spinning top. It just means sort of indecision. But if you do end up with a big down candle, and that's right, listen, look at all three of these candles. This one stopped at 69. That's the previous all-time high. This one opened at 69, wicked above, couldn't get above the 69 high. And this one, that's the top of the wick, right? So you want to be above. To me, the real confidence comes back above 69.
Yeah. So just the couple things I had question on is number one is we noticed that Bitcoin sold off when the market was weak and then bounced. As soon as the Fed kind of kick-started the risk on trade, Bitcoin ripped right back up. So are you pretty, as of now, Bitcoin's a risk on? So if you see the stock market, let's say, dump 10% like Mike's talking about, you would anticipate a significant pullback in Bitcoin?
I don't see it that way. So maybe I have cognitive dissonance, but we've been some sort of uncorrelated and showing relative strength for so long that in Mike's words, show me the beef, one day where I think everything reacted to FOMC, but I don't think Bitcoin went up because stocks went up, if that makes sense. So I think everything reacted to the same news event. So that was the correlation, but I don't think the moves intraday of stocks are really affecting what's going on with Bitcoin. I mean, I think we had our own sort of mini bubble pop at 74, right? We went from 17,000 to 74 without retracing more than 22% at any point on the way up. I mean, this is much shallower corrections all the way up. To be frank, I would love to just go sideways for 6 months. I would love it.
You're going to get some hate on that too, buddy.
But I would love it because it would be more healthy than flying straight up.
That's the thing. You have to get hate. Like I say, I've never been right on a call when everybody agrees with me. When you get the disdain, and certainly when I was running real money, that's the only time you really use your right, when people think you're an idiot. And I think one thing I'm getting my sense from the macro and talking to money managers and looking at the flows, which I show is total of almost $12 trillion in Bitcoin ETFs. I mean, that's an all-time. It's hard to see it on my screen, but that's what I show. This is my screen. This total inflows. Is the macro money managers are getting the fact that, okay, we all know the equity markets in like the 95th percentile, the most expensive it's ever been, but Bitcoin is doing what it's been called the fastest horse in the race. Basically, if you long the equity market, you can put a lesser position. If you're bullish and you want to be exposed, you can typically use a lesser dollar amount in Bitcoin and get the same kind of exposure because of the volatility, the fastest horse in the race. It might go down as much, but to me, that's what the sentiments that's shifting in the macro with Bitcoin. It's just, at some point we're going to get this correction, we're going to get tested, and that's, of course, most people have listened to McGlone. You've been saying that too long. I'm like, yeah, I admit that, but one thing that's been happening is Bitcoin, as Scott mentioned, has been outperforming. So I think that's what's happening is people are saying, okay, we'll lighten up on the risk and the asset and beta and buy something that's maybe an alternative.
Gotcha. So just turning back to the economy, you kind of, Mike, you're talking about a 10% correction in the market. Does that coincide with a recession later this year then?
That's the big test. Like I said, we're about 13% above this gap. And to me, that's the test we have to get through. So this correction here we had to the bottom in the S&P 500 to October was 10%. And that's basically when copper bottomed, and crude oil actually spiked that, and Bitcoin had a pretty good bottom. We haven't had any more than 1.5% down week since this low. That's a classic sign of a suck 'em in black hole rally. And usually when it goes up on the escalator like that, it goes down in the elevator. It's just the way it works, and there's good reason for that. I showed you the fundamentals, and it's timing now. It's getting towards the end of the first month. So my thought is, if I'm running money, I'm looking at, let's see if I want to trade in anything like that's related to beta, and everything is. That is the overwhelming force that you have to be cognizant of until we get that 10% correction, which we will. Question is it from another 10% higher and then we go down, or we do it now? Until we get that, you have to be cognizant it's going to come, and that's going to be the big test. So I've been calling it the big test, and let's see how things respond to that. It might be the beginning of that recession that some indicators I showed you earlier that's already showing up in retail sales and demand for diesel and corrugated boxes and all that stuff. But we got to get through that test. From a trader standpoint, which is what our focus is, that's where I think you have to be nimble, but there's a lot of strategies you can do that take advantage. And that's why I've been looking at lately. I just put out the other day that it's like this WTI level up around 83 was a pretty good short, I think. I can't really do that, but I think traders are thinking that. And I look at the DEES contract because you don't have to roll that. DEES has been the significant one. It'll go until December, and it's right near the high. It got to near the high of last year.
So, Scott, turning to you, are you in the camp that we'll see a recession, this year, or are we going to avoid it like the Fed kind of dreams?
If I had to make a funny comment on what's likely to happen with recession, I don't know if you guys can still hear me, but if I can make a funny comment on what would happen with recession, I bet it happens the day after the election.
Mm-hmm. There you go.
If it's going to happen in 2024, it's like on November 6th or whatever that date is. I haven't looked at what the Tuesday is, but at this point, I have extreme faith, as I've said over and over again, that the government can find a way to kick this can down the road long enough to not ruin the election. Then we'll see.
So does that, and not trying to be political, but is that on purpose then? I think that's kind of the way the government works. I think that would be that way regardless of who is in power. Listen, it's going to massively affect the election if the stock market crashes or if we go into a recession within the months before it. And listen, I have no political opinion. I don't really care. But like from any major metric, people love to hate Biden. I don't think it's even him. I mean, I think he's asleep at the wheel, but the economy has done exceptionally well during his tenure. Yeah.
Everything's making new all-time. Maybe a poor person doesn't think so, but certainly the wealthy people who are watching markets continue to rise. Apparently unemployment's good, even though it's literally all migrants and second jobs, but nobody wants to talk about that, right? The numbers are good. All they have to do is keep them good for another 6 or 7 months, right, and we're done here. So yeah, I mean, they're the can kickers, man. That's what I've told you. What has changed with me is not that I don't think a recession's coming. I do. First of all, it has to, right? It's just that I've become more impressed with the can kicking ability of the United States.
It is remarkable. It is remarkable from the Fed kicking the can even to the government, like you're saying. And and unfortunately, and I was even listening to Mohammed Al Aryan, who I really do respect on a lot of these topics, and he was saying this morning, on CNBC that the can's being kicked, but like there will be a reckoning day. There's no, I mean, it might be 10 years from now, but there is a reckoning day where the inflation, the debt, the Fed balance sheet. Again, the Fed talked yesterday about how they were going to start winding down their deductions on their balance sheet, which again, it's only down from 9 trillion to 7.5 trillion, which jumped, I think, from what, Mike, you might know the number, from 3 trillion before COVID to 9 trillion. So every crisis, they reduce their balance sheet by like 10%, and then it goes up 100% in the next crisis, 10% down, 100% in the next crisis. And it's just like, it's like this isn't going to work forever.
So what's the difference this time is we have an unstoppable increasing deficit, right?
Yeah.
And the difference in human nature is we have learned the lesson of too much liquidity and inflation. Inflation crushed everybody, most notably those in the world who are not of the Western elite, who are just average income. It crushed everybody. That lesson will resonate forever. And I think when people say we're going to have this massive liquidity pump, they're already pricing in easing, and forgetting the risks of what happened the last time we eased too much, we'll be told this for the rest of our career. So to me, that's what's changed. Those days of the Fed, the ease of Fed easing, yet the market's priced for so much of it. And that's what I show you. What do you look at? Debt clock. Okay.
I'm just showing you the debt
yeah.
clock. I just pulled it up because I wanted to see, and it's fun to watch the numbers move. 34.5 trillion, adding a trillion every 90 days or so. That's getting faster. So my argument basically for the can kicking is they don't care if this is 37 trillion at the election.
So
right? They're
that
not trying
is
to fix this.
What's the difference, right?
That's the part of the bid for gold and Bitcoin. And the key thing I've been saying for gold forever is you just can't really hold gold anymore without some Bitcoin in that space, or you're potentially missing out in the digital revolution. But that's the macro. And the key thing is that the election is going to matter. But what's really rare is to not elect an incumbent when the economy is doing fine.
Yeah, that is true. That is a very, very good point. That's usually a no-brainer that the incumbent will be elected historically, but I think the biggest thing is people seem to care much more about the debt now, about it, and I think that's part of the Bitcoin crowd and the understanding of they're kicking the can down the road, but people that are my age, our age and younger, we're gonna feel the effects of this at some point. And it's not like the money's coming back to us in a meaningful way. It's being spent now. What is there, $1 trillion in interest payments? I mean, that alone is more than we spend on the military now.
Single largest line item on the budget.
We know that's wasteful. That's absolutely a waste. It doesn't have to be that way. That trillion, if we didn't get in this situation, could be put towards helping people in a certain way. So I think there's definitely some keys here, and it's unfortunately it's not pretty. It's not pretty. It's just a matter of none of us know when that can't be kicked anymore.
Yeah, I agree with that 100%. Go ahead, Mike.
That is a very depressing chart. Thank you. Let's turn that one off, because I was just like, oh man, it's making me think gold's only going to go higher. But one thing I want to tilt over is what I show you in white. That's just Fed funds, and in gray is what the futures market expects it to be in the year. So when Fed funds go down in the past, futures predict it. They bounce sometimes and they fail. So what's happening now is, we got Fed funds. The average right now is around 5.4, 5.3%. We're looking for 1 year from now, they're going to be 4.26%. That is, the first time we had 100 basis points priced in this cycle, it raised another 100. So I don't think this happens, that we get these cuts until this just reverts a little bit. That's the S&P 500. Just a little correction.
Mike,
now, these are big ones.
Mike, what are the chances that we get a 0.25 rate hike?
There you go. Well, that would be, zero. Okay. So it's silly. It's like when people say, crypto people say this something, when they say, not so much crypto people, like gold people always say, the price is being manipulated, and the ETFs don't hold the gold. I enjoyed that. Crypto people say things like, or not just say things, they're gonna change their target. No, that's set in stone, the 2% for the Fed. But the bottom line is we have.
I'm sorry. Do you really believe that though? Because even I have a hard time believing that. Like if we go into a recession later this year, do you think they're going to be like, no, we can't cut rates anymore, or we're going to stay? Let's say they do one cut and then we hit a recession. Are they going to really say that?
If we go to recession, my view is we're going to have severe deflation, very much normal followed the severe inflation. It's the way it's always worked in history, following the biggest pumps of liquidity in history. The most recent example in history was the 1929 and then the 30s area. We pumped up liquidity much more than what happened in the 20s. And then what happens, you always have a deflationary recession. Historically, it's always worked that way. Is it different this time? As we both said earlier, it's just a matter of time this thing kicks in. How long we can kick the can down the road. It's just the way it's always worked. Now, that's happened in a lot of commodities. I point out it's happened in natural gas. Corn's already done it. Crude oil's way off the highs. Crude oil is well below its peak from 2008. And gold's picking up on that. Bond market's picking up on a little bit. The rest of the world's going to recession, and that's where that U.S. stock market right here, it's got to stay up.
Was in the Great Depression, though, speaking of which, was there, I mean, you didn't have the Fed printing money, or did you have the Fed printing money like they are doing now?
They started cutting rates in 1924, and part of it, they cut them to the lowest in the world. A lot of that changed the gold flow. And they started hiking rates in 1928 when things got out of hand. And then at the minute the stock market going down, this was a New York Fed, they started cutting rates. Now, I've done the history and checked in this, but the thing that really they did wrong, the Fed was okay. They started hiking a little bit too early in the 30s, but it was a Smoot-Hawley Tariff Act that really crushed things in 1930, that shut off international trade. But the bottom line is, what bottomed all the deflationary forces when we debased gold from $20 an ounce to $35 an ounce in March 1933. That ended everything. That ended the deflation because we debased the currency versus gold. So those are severe things, those kind of things, it might take something like that to end this target, but that's my point. When people talk about these things, that was severe depression, and you need a severe. So it's the key thing you said when you started about potential for shifting from a 2%. It's that if statement of a recession. You have to get that first before a consideration. You have to have some kind of catalyst to get that shift in a major benchmark.
But Mike, if they can't get to 2%, why wouldn't they hike again? Why are we talking about cutting if inflation's ticking up? So that's why I don't understand pricing in 3 cuts. Or even
because of things like this. Because of things like this. I mean, retail sales are pretty bad. The yield curve is still, I mean, it's the things that you can see, and PPI is finished goods is negative. The average of PPI in the top 4 horsemen of the world is negative. That's minus 2%. So the leading indicators are very negative for inflation, and it's the normal reversion. So, there's a lot of other things they're watching, but also here's the bottom line. And Chairman Powell did say it, the uptick in unemployment. If that continues up, and we both know it never just bottoms around 3.4%, peaks around 4%, it goes up to 6%. Maybe it's different this time. That's like I show you all these indicators. Maybe it's different this time, but what if it's not? Like, we still have leading indicators below 5%.
So when you say deflation, and just to be clear for everyone, you don't just mean like lower inflation numbers, because I think a lot of people get confused. Like we hear, there's not as much inflation, but it's not that prices right now are going down; they're just going up slower. But you're actually talking about prices going down.
So let's look at price of gasoline. Remember, gasoline peaked at $4 in 2008 and dropped down to below $1 in 2009 and 10. That's deflation. Now we're going to get that. So look at, and the way deflation always works. Inflation always works. It's the bar. It's the when you raise that bar so high. So like the average price of a home in this country has jumped up from around $200 to $200,000 to around $400,000. Just going down from that base effect back down to 3. That's deflation. That's the way it always works. The deflation always is when you pump prices up too much, then you come back and you mean revert. It's simple mean reversion. That's always the way it works. You never deflate from low prices. You just deflate when you pump them up too much. And the biggest liquidity pumping ever, pump prices up way too much. The most in history. It's the lessons of the book, The Boom and Bust, The Price of Time, that's the way it's always worked.
Interesting, man. Oh man, it's last thing I'll ask, Mike, is and I'll throw this to Scott too. Do you guys think by the end of this decade we are in a Great Depression? Is there that chance because of what you're talking about, or is it a mild recession that the Fed prints us out of one more time and the debt just keeps ballooning?
Well, I'll go for on that one. To me, it's one bridge at a time. To me, the first bridge to get through is starting with the first 10% correction in the stock market, and then see where we go from there. The big picture, we'll be able to see guidance, and that's part of the reason I think some of the best performing assets will be U.S. Treasury long bonds, gold and potentially some Bitcoin in that space, as we just see a normal reversion in the U.S. stock market. So a normal correction historically in the S&P 500 is to 3,000. That's not a big deal. That means gold, they kind of meet together. But that's one bridge at a time. What will happen, we'll probably have a decent amount of deficit spending, but look at Japan. I mean, their rates are less than 1%. They finally tried to hike rates, and they have severe deflation. So debt becomes less of an issue. It's just to make sure they pay it off. So one bridge at a time. But the key lesson I've learned, particularly when you're the world's reserve currency, is when people say that increasing deficits will increase bond yields and you're supposed to short bond yields, every time I've heard that, it's been the wrong trade. And it's only been since 1993 I first heard it. Hey, 1988 when I first started hearing it, when I was in the bond pit in Chicago.
All right, Scott, let's hear it.
Yeah, even though Taleb hates Bitcoin now, I still love his books, right? And I've read Anti-Fragile a few times, and he always makes the analogy that many do that, like a forest fire. People, they start small fires to burn out the brush and contain it so that you don't get a bigger fire when the big one comes, right? And so you need to have the small corrections. You need to take care of the small little things, or else the fire will eventually be bigger. Can't say we'll have a Great Depression, but I think when you put that debt clock on the screen, it's terrifying, and something eventually has to give, right? I don't know when that's going to be. I don't know the extent of what that will be, but I'm not confident that they've put out any small fires. In fact, that they've burnt any of the brush with any small fires. I think they're just letting the brush grow. And so, yeah, I would say that I'm very concerned. I don't know when it's hard to put a date. You look like a doomer. Everybody thinks you're crazy, but yeah, I think like eventually the bills are going to come due.
Yeah, I always like to kind of just align it with an individual. Like, if you and I run up our credit cards endlessly, eventually what happens? Eventually the credit card company shuts it off, and then we're in a big pickle, right? So at some point, granted, the US is the best house on the block, all those analogies, but at some point the bill comes due. And the thing is, if you look at what happened, and Mike and you guys, I know, the austerity measures that, Italy and Greece went through, at some point that will have to happen here. And that means a massive cut in spending to the point of getting, and by the way, probably tax hikes too. And tax hikes, and the combination of those two are going to be brutal stuff that people that started investing since, I don't know, 2018, 2020 have never even thought about, and what that means. And again, not to be a doomer gloomer, but it's just understanding the repercussions of what path we are on down the line.
Much appreciated. Not being a doomer gloomer. I earned that nickname last year by pointing out facts of what usually happens and where things are going.
All right. Well, on that doom and gloom note, let's end this Market Mavericks session. You guys, thank you so much, guys. The socials are at the bottom there. Please follow these gentlemen. They are awesome as always. Really great conversation today, guys. Thank you so much for joining, and we'll see you next week.
Thanks,
Take care.